Hello. Welcome to another video from 10x Investor Education. So, making 10x of your money not going to happen overnight if you are thinking you have to buy only penny stocks and SPACs. So, in this video, I would like to cover what's happening in the stock market right now, what is causing the market correction, what's happening in the market rotation and stimulus bill and next infrastructure bill that is coming up soon. So since December of last year, which is like close to 3 months, a lot of new money flowing into value stocks that includes financials, energy, which is oil basically, and cyclical stocks. Especially last 2 weeks, after 10-year Treasury rates went up crazy, there is a huge sell-off going on in tech stocks, especially work from home stocks, SPACs, and then penny stocks, speculative stocks. So why do these stocks get sold off? Imagine most of the SPACs, some have a lot of good revenue potential, but most of the SPACs are very speculative. They just have $5-10 million revenue, and they speculate that it will grow up 10x, 5x next couple of years. So people pumped into those stocks a lot, driven by Chamath and a lot of other people. End of the day, if those stocks, when the sell-off starts happening, those are the one people made a lot of money. That is when people start selling, take profit, and store into cyclical stocks. Okay, so remember these are very speculative and there are a lot of revenues. So if you go to ETF.com, there is a link that tells you inflows and outflows of money, which ETFs, which sectors getting into. Okay, so if you pick last 2 weeks, the highest ETF that got money is XLF, which is financials. So I hope you have some financials, some REITs, some cyclical stocks, not just SPACs and penny stocks. So there is nothing wrong in just having tech stocks, hyper growth stocks. But when this correction happens, you will see your portfolio tank like anything. Remember, last year 2020, it was growth stocks that made a lot of money. So Berkshire made only 2% made, whereas Vanguard Growth portfolio ETF, simple portfolio, made 60% return. So Berkshire is going to do really well because it's heavy in financials and value stocks this year, and growth is going to moderately do well. So that is the reason you have to see which year what it is. If you had invested in Berkshire last year, you screwed up your money. You made only 2%. But if you have hyper growth stocks this year, same thing. It's not going to work out like that. So hope you have some diversification. So the last 2 weeks, the highest ETFs with money redemption is QQQ, which is Nasdaq 100, SPY, which means S&P 500, gold ETFs. So gold and SPY lost a lot of money, including QQQ. Reason because S&P 500 also has a heavy in tech stocks. So if you're well diversified, there's nothing to worry because the drop in tech stocks will balance you. But if you're an active investor, try to rotate money every couple of months to take advantage of the next couple of months potential. That is when actually for this year you need to load up into cyclicals and then value stocks on top of some growth stocks. Okay, so remember, stock market, when treasury rates went up, doesn't mean that everybody going to sell off the stocks and put in treasury bonds or ETFs. Yes, some people will, like 5-10% of the money will go into treasury bonds and ETFs, but still I'm not happy with 1.6% return for 10-year note. Okay, I don't think a lot of people are happy with that kind of note. It can kind of returns. So a lot of money is still going to come into stock market, but where it is going depends on it. So if it's going into value and cyclical stocks, that is where those going to go up. So there is always a fight between the growth investor and a value investor. So some years the value wins, some years growth wins, depending on it. So in general, you cannot have 100% growth. In general, you cannot have 100% value. That's not how it works. Okay. So the way you need to trade this penny, okay, so I have a lot of SPACs too. I have a lot of videos on SPACs, but I have a lot of bank stocks, oil stocks, dividend stocks. I don't make any stock on I don't make any video on Bank of America. Nobody going to watch it because nobody interested in it, because people are looking for, how to make 10x, next 1 month or 2 months. So, but that is fine if you having speculative. There's nothing wrong in carrying these high growth, hyper growth stocks, but you need to hedge them heavily. What it means is, for example, Senseonics, right? That's a dollar stock that went to almost $5 just 2 weeks back. So Senseonics, when it goes to $5, you need to sell off almost 70-80% of your stock in covered calls, take $2 premium out of the stock, and diversify that money at that time. Don't buy the Senseonics at that time again. Now is the time to sell puts in Senseonics when it goes back to $1.50 or $2. So when you buy, when stocks goes up, you sell covered calls, and when stocks goes down drastically, you sell covered puts. So you don't have to buy the stock again. Sell covered puts at a much 20% lower price, and you get the premium. And if stock falls, then you buy. So you have to do with only good stocks that have revenue potential. You can't buy any very random speculative stocks. So that is how you hedge them. Hedging is important, especially on growth stocks and speculative stocks, because that is how you can capture the market. You can juice up the premium, take the premium, and rotate it. So whereas take value stocks like Bank of America, you don't get much premium. In speculative stocks, you get 20-30% premium. Whereas Bank of America, even 6 months or 1 year strike, you probably get 10% premium. So even if Bank of America goes down like 30%, like last year, all gas stocks went down by 50%. Bank of America stocks also went down by 40-50%. But at some point, these banks are also cyclical stocks. At some point, when economy has to improve, the interest rates has to come up. So they'll come up. So this time is what you lost, but you don't sell off Bank of America stock for 30% loss. So you need to understand how to trade. Whereas the speculative SPACs are dangerous, you need to hedge them. Whereas the low premium stocks that pay low, covered call premium, you don't have to hedge them. You can hold long term and diversified portfolio. So this is not new. In a couple of videos explained, like I sold off 100% of my stock in covered calls, and I'm waiting for that stock to fall off to buy more. So that is how I have been trading. Yes, my SPACs, my penny stocks went down, but my dividend stocks went up like crazy. Bank stocks went up like crazy. Gas stocks went up like crazy. So that is where it's compensating. But still, since I sold covered calls, some of these today I bought a couple of covered calls back on pennies. So if I got like $4 premium, today I bought them like 20 cents back, because stock went up. Bingo stock went up $15. I bought it at $2. It went $15. I sold covered calls. I got like $6 premium. It came back last Friday. So I bought it back again for 50 cents premium. So that is how you rotate them. So high, sell covered calls, low, sell covered puts. So that is how you have to do with speculative stocks. Whereas non-speculative stocks, it's not that risky if you don't do that. Okay. So that is how summary of market correction that's happening. The cyclical, or the market rotation happening to cyclicals. So it doesn't mean that I'm out of growth stocks. I still have a lot of heavy growth stocks, but as I said, I hedge them. So I'm trying to buy back some of those. Okay. So next I want to talk about is two things quickly. The 1.9 trillion stimulus bill that is will be signed by President soon and become law, and the money will come in a month. So a lot of that money is going to flow into market again, and I don't think a lot of people going to put that money take in treasury notes. Okay, so as I said, remember, start of money going to the market. Not many people going to save that money in banks or treasury notes. So, but you have to be in the right sector at the right time to capture the growth in the stocks you buy. So after this treasury bill, so Biden and Democrats are proposing another 2 trillion, okay, not 1 trillion, 2 trillion infrastructure and clean energy bill. This clean energy bill also includes roads, infrastructure, bridges, electric grid, modernization, and a lot of union jobs. Okay, so but this time they are not going to get a free pass. So Republicans ask for, how are you going to pay for the bill? So the rumor is, again, they want to increase. Biden proposal is increasing corporate tax. So if you increase corporate tax, again, the worst performer will be tech stocks again, because they are the one, make a lot of money. Amazon, Facebook, they make ton of money. They are the one, because that is affects a lot of them because on profit margins. So corporate tax is not good for tech stocks again. Inflation is not good for tech stocks. I mean, usually the treasury rates going up is not good for tech stocks. So there is a rumor still not confirmed yet. Okay, and also there was a so climate change, clean energy, infrastructure. That's what going to be next $2 trillion bill. So the important point is you got to buy, understand, get into those before actually they go up, right? That's what it is. So that's the reason why I have been buying some of the stocks for last couple of weeks. So there was a huge sell-off in solar and hydrogen stocks, because remember the ICALN went up by almost 160% 2020. It came back almost 30% down. So I sold covered calls, but I am not selling off the positions in the stock of mine. For me, it is a long term. So whether you take plug, Ballard Power, fuel cell, these are still long term. I'm still going to hedge them, but still long term. The reason is, gas stocks I invested, but the short term cyclical. Next 1-2 years I make money, but that's not 5-10 year plan. Okay, the 5-10 year plan you need to understand is clean energy, climate change. Those are the companies still going to be there. So that's the reason why people pumped up so much electrical stocks, EV stocks, right? Not like short term, it's long term. Okay, so what I have been buying are related to this, still in this, when the stock market went down. Okay, so I have picking very selectively some of them and buying, adding on those. For example, if you look at, there is this company called Star Peak Energy, which is merging with STEM, so which is a clean energy play, that was trading at $55 just 3 weeks back. I know that is heavily priced at $55. I didn't want to buy. So last week it came back to $20. That is when I grabbed some. I also sold $10 and $15 puts on that. So I'm buying some of these because this is the golden chance for me to enter into, because I never wanted to buy $55. Okay. So similarly, I buying cement stocks, CIMEX, CX symbol, PAVE, which is a infrastructure, because you can't buy lot of infrastructure plays. You can't buy lot of stocks, so you got to buy some in ETFs and some energy play. Okay, so if I bought Star Peak Energy, doesn't mean that I am taking the risk, because Star Peak Energy STPK can go back to $15 also. So when it came back to $25, so I sold off covered calls, got the premium $5 at $70 strike price. So I'm reducing the risk by 20%. So even the Star Peak goes to $15, I'm not still loss. So that is what I keep telling, if Star Peak goes to $60, my stocks will be sold off, but still I made like 3 times the money. So that is how I trade with that margin. Okay, double the stock price plus 30% premium, that reduce the risk of the original investment, especially if you're buying these SPACs. Okay, so I will talk in my next video the infrastructure bill in detail and what stocks I am buying for that and what is my plan and how I am diversifying it. So at the night, every day, you should not be looking at a portfolio, you know, tensed up. So as long as you have some diversification, some plan, something goes down today, last 3 days, you not be worried. Is it a long-term plan? Is it a short-term plan? Okay. If some penny stocks goes down, do you have hedge? If you don't have hedge, you are screwed. If you are hedging, yes, you are okay. But if your Bank of America goes down by 10%, don't worry. So that is how I think in the market. Okay, so I'm not worried at all. In fact, it is a blessing for me. Second time again, it's a blessing for me because I'm able to buy Star Peak Energy, CMLF, and some of these at almost 50 to 60% discount. Otherwise, I couldn't have bought those. I would have not invested in those. So this is the plan and this is how I am trading. Please let me know what you think, whether you agree with me or not, whether you are hedging the stock market or not, whether you are still investing only in SPACs and speculative plays. I really appreciate some feedback. Please like the video and see you on my next video. Thank you.